Picture this. You're sitting at your desk staring at a sea of red on your trading screen. That position you entered with such high hopes just keeps sinking, day after day like a stone in a bottomless pool. Your stomach churns as you watch your hard-earned gains evaporate before your eyes. Sound familiar? If you've ever found yourself trapped in this trading nightmare, then listen up, because today we're going to reveal the one simple trick that can save you from this mental and financial anguish, cutting your losses short. I'm Rick Pedicelli, head stock analyst at Morpheus Trading Group, and I've been in the trenches of trading psychology for over 2 decades. So we know that trading is a game of probability. We have to do the things that are in our control. We have to do them well. Taking that's from the entry, the correct entry, knowing our stop in advance, sticking to that stop, knowing the position size, portfolio risk. And even before all that, are we taking a trade that fits within our system? Are we doing everything we can to be disciplined and minimize the errors? As all this will eventually factor into our bottom line. Although traders spend a ton of time figuring out when to buy a stock, it's the sell that's so much more important, whether that be the sell into strength to lock in profits or simply following a predetermined stop to exit the trade. The exit is so much more important. And that's where you can really get into trouble when you talk about risk of ruin. We always want to be in the game. We would never want to be forced out. Not having discipline with your stops is the quickest way to an ugly drawdown, and even worse, potentially, blowing up your account and not even being able to trade in the future. In this video specifically, we're going to cover why taking that first loss is so very important. And of course, all losing trades suck. Who wants to lose any trade? But losing is part of the business, and we have to deal with that. And when we don't deal with that, we become sloppy. That's when the loss gets out of control and can really become an issue with us psychologically, as every day we wake up and you look at your open positions and you have 4 or 5 good trades on, and then you have just one trade down 20%, and right away you're in a negative mindset for the day. You haven't even put on a trade yet and already you feel bad. So that's what we're trying to avoid. So it's not just the dollar loss, it's the emotional toll that this takes. So with that said, let's jump into the trade example we have here in shop. And this is nothing fancy. We're just showing a stock that we saw that was on our watch list that we tried to play back in March, and it didn't work out. But we cut our loss and it was no big deal. So first, let's get to the setup. We have, a downtrend line break here, some higher lows in place, some resistance at the 50 MA, the 8 and the 20 are pinched together. So what we're looking at is if the price can break this downtrend line, push back through the 50, it could reclaim the 50, and then if it can hold above the 50, the 8 and 20 will start to curl up and support it, and we can add to the position as it moves higher. That was our thought process. So in setting up the trade, we have a buy entry at 78.70, which is maybe like 15-20 cents above the high of this bar. And our exit is a break of the same day's low, minus 20-30 cents. So in a $100,000 account, say we take a 10% position size, that's rounded to 125 shares, a 78.70 entry, stop 75. Distance to the stop is 4.7%. We're risking $470, so 1/2 of 1% of portfolio risk. So that's the trade setup. That's what we know. That's what we have in place, and that's the plan we have to execute. So the following day, we have a trigger, and we're long. Our volume picks up slightly. Next day, we have a reversal and a pickup in volume. Now, depending on how active you are as a trader, maybe you're taking some off the table. Volume was pretty big, and there's a close at the lows of the day. But let's just say we're still long. Next day, even lower. Close at the lows of the session, breaking the 50. Not ideal. Continues to chop around. There's a little bit of a reversal action here. Hopefully that can hold for us. And it doesn't. Another reversal here. Hopefully that can hold. And that does not hold either. And so we're stopped out. Say we're stopped out right around here. 75. So that's it. The trade's over. We've lost 1/2 of 1%. Maybe less if we're a little bit more proactive. But 1/2 of 1% is the loss. We followed the plan. We're out. To me, that's a good trade. You're doing what you're supposed to do. You had a trade set up in place, triggered. You followed the plan. You're out. Nothing wrong with that. You can go back and say, maybe I could have done this wrong or this wrong. But overall, you did what you're supposed to do. Good job. However, say we didn't exit here and we said, it's going to come back, or maybe we're in a bad spot mentally for the day. We're thinking, I don't want to take the loss right now. Let's see if it can bounce back. All right, fine. Let's see what happens. Get a little bit of a reversal. That's great. I'm going to stay long. Went lower. Overall, though, closed close to yesterday's close, so or open, so I'm still okay. Still chopping around. Ooh, gap lower on me. That sucks, but it is on top of this downtrend line here. It's the back test of this downtrend line, and this is just the trading devil side of your head thinking, maybe I can hold it here. Oh, he went even lower, but there's a reversal candle. I'll stay with the position. Oh, then it went lower again. Well, I'm close to the 200 AMA. Let me stick with this. And we're at the 200 AMA, and now you're 13% down from the entry. Loss is $1,283. You're down 1.2% of the portfolio value, equal to nearly 3 stop outs. So over this time here, you could have just stopped out right here. And if the market isn't getting blown up and this is just shop selling off, this wasted time and money could have been put into a stock that is trending higher with higher highs and higher lows in place for something with lower highs and lower lows in place. And that trade would presumably be above the rising 10, 20, 50-day moving averages, where Shopify is below the 10, 20, and 50, and right at the 200 MA. So we're at the 200. We're waiting for a bounce. And the price action bounces higher from here. And then we get a big recovery. And now we're close to the stop out, the original stop out. I mean, if you held this far, this is your chance to exit. But, who knows when you're in a bad spot mentally what you're thinking. Probably thinking, well, maybe this trade could work out after all. Then it gaps lower, recovers, bounces higher, and then it's chop mode. And now you have a breakout, and now you're through the 50 MA, and maybe even, you're through a downtrend line too. So that hold for you now has paid off, as you're probably even positive on the trade or close to it, or not really yet, but close to it. So you've gone from being down negative 1.3% to close to being break even. Great job. So you're going to hold on to this trade. And there's earnings probably in your way. And boom. Now, knowing that you had earnings right there, you could have gotten out. But say you didn't get out there, look at the spot you're in. Not a good place to be here. Things are starting to get out of control now. And if you're still holding, this is where it can get really dangerous too, depending on your position size and the size of your account. Maybe you have a smaller account and you're trading bigger size. So maybe this 10% position is more like a 20 or 25 or 30. This is where it can get really ugly. So anyways, from here, let's just hurry up through this example. We have the price action continue to sell off, and then at one point, we're down 28% from the entry. We have a $2,800 loss, 2.8% of portfolio, and almost 6 stop outs. That's a lot of money to waste on one trade that was probably showing promise for all of one session before it reversed lower. So we put ourselves in like 56 days total of anguish just because we couldn't take that stop, or less than that because the actual stop out was around April 4th. So 40, 45 days of pain, almost 2 months of dealing with a trade that turned sour and now is getting ugly, and every day is sitting in our open positions, taking up and draining our mental state. And who knows where this person gets out. I mean, sometimes it's possible that they never do, and it just goes lower and lower, and they're holding the stock for 6 months to a year, and they just chalk it up to a mistake they made, and while their other trades aren't as bad. And, this whole situation is just something that, I personally haven't dealt with beyond this point right here. I haven't really gone into this area where we're, maybe it's a 10 to 15% loss, but I've never gone into the 20, 30, and the 40s on a trade. But this is where it can turn really ugly, and you don't ever want to be here. And truth be told, I don't want to be in here. I don't want to be in this area. Mentally, I don't like the way I feel during the day, and it just takes up a lot of energy to deal with that loss. I'd almost want to just off my books. I don't want to be looking at it ever. And I've had a bunch of these trades in the beginning where I just couldn't take that small loss, and it just inched lower every day. And this is how it always works too. It's maybe not always just a brutal sell-off. It's where it'll go lower each day and give you a semi-good reason to stay long. A little bit of a reversal, or there was a push lower, but the close was above the prior day's low, so it's not all that bad. And then it's usually followed by the gaps that trap you. and you're stuck with your trade and your crappy mental state. So what can we do to prevent this sort of thing from happening? I think it's just you got to make it a priority to never be put in that position ever. There are a few things you can do to help you with that. One is to have a max stop loss where you have your average stop loss. Say you want to be out at half of 1% of portfolio value. Say your max uncle point is 1%. It doesn't even matter where the stock is, you're just out. If it's on the open and it's gap lower, you're out. No thinking about it. It's at your max uncle point. There's just nothing else you can do. No more trying to reason why the trade should still be on. You're out. That's it. It's over. Done. Another thing that can help is just making sure your position sizing is on point. Especially if you struggle with stopping out, maybe going with a smaller position sizing will be helpful in the beginning to get you going. That's a dangerous game if you're gonna, if you don't have the ability to stop out, you lack that discipline, and you have big position size. That's not a good combo. And one thing we like to do to help with taking the small loss is to actually just exit small size if you find yourself freezing and unable to do anything. So if the stock is dipping below your stop loss level and you find yourself unable to do anything, you're just frozen there, sell a small amount of shares first. And that way, if the stock goes any lower, you're losing less. And if it reverses higher, you still have some shares on. And then if it heads lower after a pause, sell some more and then sell some more and keep selling until you're out. That'll free you up. You don't want to have this all or nothing approach. That might, cause a lot of indecision as you don't really want to sell it there and then have the price action immediately rip higher, leave you with a ton of regret. So selling partial size can really help.